Second Chance Tuesday, folks. Thank you very much for giving us this opportunity to meet so many exciting prospective CEOs and founders. That's always what we're after in the VC business. Apologies first. This is a slight regurgitation of some slides I've used in the past. So if people recognise stuff, just tell me to move quickly. I'll try and whiz through it. And there are a few things which are different on this one from the last one. So see if you can spot them. So basically, just before we start, I'll just say a little bit about us. I mean, I work for a company called Index Ventures. We're based in Geneva and London. We do a mix of life science and IT investing. We're particularly active in web and internet businesses. I don't know how many of you are involved on that side. And some of the investments that we've done, there's a mix of some life science deals, as I mentioned, enterprise software, some sort of service businesses like lovefilm.com, DVD rental business, some telecoms, and then, as I mentioned before, a lot of well-known, either established or sort of up-and-coming internet businesses. I'm going to talk a little bit about the VC industry and try and give you a perspective of how we make money as VCs, because I think when you understand how we're making money, hopefully, that maybe puts some of the things that we do and some of the decisions we make in perspective, I think. And then we'll talk a little bit about when to raise money, strategies, and once you've got multiple options, if you've got multiple options, how do you really decide on the right team to work with? So just very quickly, we raise money ourselves every 2 to 4 years, and I think entrepreneurs maybe there is some empathy for entrepreneurs raising funds, because if we're not successful, we don't succeed in raising funds ourselves, and we typically get out money from various sources, pension funds, fund-of-fund investors, and so on. What we aim to do is invest that money over 3 to 5 years, and then exit those companies in the 3 to 7 or 8 year range. And the typical model for Europe, I'd say, and this is probably slightly different in the US, I'd say half the deals you do, you'll lose some or all your money. A third of them you'll pretty much break even, and maybe 1/6 you'll make hopefully lots of money on. I'd say in the US there is probably a greater appetite for risk, more failures, because multiple versions of the same idea tend to get backed in the US. But when the successes are big, they tend to hang on, because the VC firms there have had significant successes before, so that they're not really looking for the 500 million or even the $1 billion exits. There have been many more multi-billion-dollar exits in the US, and companies like Google, Yahoo, Apple, and so on all come to mind. We basically get a management fee which kind of allows us to cover our costs, and then we get a carry. So over and above the money that we raise, we any returns over and above the amount that we raise, we take 20 to 25% of that. Now, the relevance of this for entrepreneurs raising funds is, I think when you come to a VC, I think it's very good to know what their how big their funds are, and what therefore that means in terms of what their objectives are going to be. So if you're in a market where the exit opportunity is 50, 40, 60 million, but you don't need much money to get there, that's a very, very attractive business, but that may not be a big enough opportunity to attract some of the VC funds which have a lot of money under management. I think this is. I think you'll probably know most of this. So I'd classify seed as 0 to €1 million, and really the sources of that are grant funding. A lot of academic institutions do offer some sort of funding or governments do as well for high tech type opportunities. Friends and family, angel investors, some venture capitalists also are active in this space. And typically what happens during the seed stage is you're really, if you're really trying to prove that there may be a market opportunity for your business. And really, I think what you should have done by the time you get to early stage is really have some idea of how big the market is, have some proof of concept of a product or service, say some feedback from beta customers, or if it's a a consumer product, some kind of some website already up and running before you go and raise VC money. And really that can be anywhere between 2 and maybe 20 million, and then later stages, often at the later stages you're already profitable, or maybe you're already profitable in one region but you want to expand to another region. And then before IPOs, sometimes there are secondary sales, or sometimes additional money does come in from strategic investors and so on. And even hedge funds are starting to be active in late stage deals. This is companies kind of in 20, 30, 40 million dollars revenue at least plus. And sorry, Index is kind of active in the first three of those areas. What a VC will add, if you go to a VC's website, they will all kind of say similar things about advice, strategy, helping you in hiring, particularly important, helping you in business development partnerships, raising your profile, helping you move from one country to another, and helping you kind of economize and move quickly by good relationships with service providers who they've worked with before, whether it's recruiters, finance professionals, and so on. Another quite important thing is exit optimization. I think firms which are VC backed do get acquired for more compared to firms which have similar kind of economics but aren't VC backed. And what drives that is their experience with the acquisition process, and also where relevant their experience with the IPO process. Now, I'm just kind of wanted to put this one up because I think for a lot of entrepreneurs this can come as a bit of a shock, and I wanted to try and justify some of this. So Gordon the Gorilla's just had his first VC term sheet, and it should be a great and happy day for him, but he's actually looking rather unhappy, as you can see. And I think this does happen, is that there is a bit of a shock, once you're over the excitement of getting offers, there is a realization that comes through when you start to get term sheets that basically it's a very, very tight relationship, and the VC is very, very much trying to bind you in for the long term. And almost all of these terms that are typical in term sheets are really around binding entrepreneurs in for the long term, because typically when VCs invest in, it's particularly in early stage businesses, there aren't strong financial metrics which you can sort of do a DCF valuation on and really attribute some hard cash flow to. The value on the business when you do an early stage deal is the promise of that entrepreneur's labor over the next 2, 3, 4 years, and the vision, and to an extent some of the traction they've already got. So what VCs and what Index typically want, we'd want 20 to 35% ownership, and that is again just because what we want to do is exit. When we exit a business, make something like 50 to 100 million, and we can do that if we're selling businesses for 300, 400 million plus. The problem if we only get a 5% ownership is that really to make a big difference to our funds, you really need to be selling the business for $1 billion. So don't go to a VC and say, listen, I'm going to offer you 5% of my company for this, because it probably won't be enough for them to A, financially, and B, to warrant the time and effort and energy that they're going to invest. They'll want to be on the board. I'm not going to go into details of liquidation participation rights. The one thing I do want to mention is reverse vesting, and I think this is sometimes does come as a shock. What we'll typically do is, if we say do a 30 million investment at a 30 million pre-money valuation, therefore a 60 million post, you would own half and the VCs would own half of the business. What will happen, however, is that they would put some form of reverse vesting on your stock, and that typically it's 3 or 4 years, so that if you after 1 year were to walk away and leave the firm, you'd only take like one third or 1/4 of your stock. And I think the reason, as I mentioned before, is that the VC really wants the entrepreneurs to be tied in, and that's the mechanism they use to do it. So you should be aware of that. Investors will want you involved in the long haul. They'll also want to put in an option pool to attract and incentivize other employees in the future. So why do you raise VC money? So, if you've got a unique product or concept and you're passionate about taking it to the next level, and there's a large market opportunity, those are the kind of ingredients that make sense to raise VC money. The issue is, if you've got a large potential market opportunity, then there's likely to be competition, and there's a requirement to move rapidly. And really, to answer, I think there was one question here about how long to take it under your own steam before raising VC money. I would say it's the competitive scenario, and the if there is an element of a land grab going on in the area where you are, then raising VC money is quite important. And raising VC money does two things. It gives you the funds to expand the team and grow, but also it's a strategic preemptive move. Usually in Europe, once one team has raised a lot of money for one particular project, typically other VCs then won't back a competing project, or you'll only get a couple of competing projects that raise VC money. So I think that is an issue. You might be doing well, but someone else might come up with a similar idea and raise VC money for it, even though they might be behind you when they raise the money. And obviously, again, once you have the VC money, it's partly funding that, as I mentioned before, all the other kind of value add that you get from having a VC investor on board. I think Simon's going to talk a little bit about this, but I'll just briefly say something. When not to raise, if you've got something which is a feature, not a product, i.e. something which on its own will never be a viable business, but when sold to somebody else actually can enhance their products and services, and actually it does have value to it, then that's probably not worth raising VC money. Typically those type of sales happen in the sort of 5 to 15, 20 million range. And typically, it's, not that many VCs would be interested in backing that type of project, which is not to say it's not a great project that you might be involved in. It's just not very amenable for VC. The other one is the market size is too small. If you're targeting a product as a very particular geography or a very particular niche, and that really constrains you to a certain market size, then that's not going to be. That'll limit your ability to raise funds. And if your motivation is not financial, if you're really if you're involved in an enterprise without the goal of really enriching yourself and shareholders, then it's not a good idea to raise VC money, because VC's jobs really are to make money for their investors, and as soon as they put their money in, that will be to the extent that they have influence on the firm, how they work with you. Now, the danger is that not that you can't raise money if these aren't true, because VCs do make mistakes often, and are fooled into putting money into companies that don't necessarily make sense. The real danger is that you, as I mentioned, you'll get locked in for 3-4 years working on a project which you may not completely believe in, but you manage to raise VC money for, and I think I have seen a few of those situations, and it's not good for the VC, and it's not good for the entrepreneur. So I think before you sign a term sheet and take in money, do kind of be intellectually honest with yourself and make sure you believe that it's a viable product, and that it's a big market, and you're genuinely motivated to work on it. Because if either of those three is not true,
can we ask questions?
Yeah, go for it.
As we go through.
Go for it.
Okay, so if you're trying to develop something that's very innovative, that would be right at the forefront of the market, and so the market size is likely to be very small in terms of the number of people today likely to pick it up, but you're very passionate with a great team, you believe you've got a product, and your motivation is financial.
Yeah.
What do you do at that stage?
Yeah, no, I think VCs are some of the best businesses are businesses which kind of destroy an industry and then recreate it. And I think we've done a lot of those disruptive type plays, and I think you need to sell the investors on that story about how your product will disrupt the market, or how a market will emerge around the product and service which you're generating. So in theory, if you've got that type of product, that in a way that's some of the most interesting businesses are built up in that sort of from that basis. But yeah, it will be a harder job to sell if there's not an existing market out there, to get VCs kind of on board with the message. Probably will take longer.
And you might want to do that in stages as well. That might be one way you do an angel round first until you prove that specific niche. And if what you're talking about is something that fits the model of crossing the chasm, that book which is recommended in the list, then you prove it in one area, and that's a nice lifestyle business potentially if that's all it goes to. But then when you can expand it into other markets or expand the bridgehead, and then it becomes a VC backdoor business. Depends very much on the context of what we're talking about.
So I'm just going to say a little bit here, what I call 3 T's. So, what does a VC look for? And I think, team, technology, and traction are the sort of the main things that a VC looks for. And when I'm out there trying to find companies and find founders to work with, I'm looking for these attributes. I think the key thing is actually people kind of assume, and very much that people's business plans, and if you're taught about how to write a business plan, they will very much kind of want you to cover all the bases. The kind of the truth actually is, though, that it's a bit of a misconception that being good and credible across all these areas is the key to raising funds. It's actually being exceptional in one of them. And I don't think any business is ever exceptional in more than one of them. Because the issue is, if good and credible teams and good or sensible technology for a particular problem, they're usually not scarce resources. The real scarce resources are, on the case of team, entrepreneurs who have been exceptionally successful before, and by that, I mean people who have created, exits generating, tens of millions of dollars for investors and founders. Those type of entrepreneurs. There aren't many of those around. And when we go early, i.e. when we've got when there's no technology, no IP that's proven IP, and when it's no proven traction yet, we really do need to be working, or believe that we're working with, an exceptional entrepreneur. Obviously, if you've got a protected technology and whether it's patented or trade secret, or some very, very unique IP, that's another kind of can be another anchor to attract VCs. Or traction. And I personally do a lot of investments in the internet area, and I very, very much try and spot projects and web businesses which are gaining traction and momentum. That may not be revenue traction, but that is user engagement, rather than trying to kind of preempt which projects will get user engagement by putting money in before something's launched. So I think when you go to VCs, yes, you need to have you need to be able to present that you've got a credible strength across the board, but really think to yourself, what is really the exceptional thing about this opportunity that's going to appeal to an investor.
To the technology side, obviously, as you said, IP is very, very important. What stage does the IP need to be? In other words, do you need to have a solid patent under your belt, or do you need to have sort of a process and a likelihood?
Yeah, so I think it depends very, very much on industry. So in web and in instances we don't really put much hold by patents. In software, not much either. In more hard science, chip, semiconductors, and so on, we do value patents, and often we'll do as Simon mentioned, a kind of seeds. We'll be happy to do a seed stage investment while something's still going through a sort of patent pending process. But one of the milestones that we want to kind of to be overcome before we do a serious big financing subsequently will be the granting of patents, or the indication that patents are going to be granted. Personally, sort of business process patents and patents in software and internet areas, we tend not to hold much store by. So on this, when you think about who to raise money from, on the VC side, and we can talk about angels subsequently, but have a look at who's doing investing. And I've put a couple of sources here, Alarm Clock and Decosis, and I think they're on the schedule which has been circulated. So find out who actually has funds to invest. Lots of VCs who have nice websites actually don't have funds to invest, and if there's no announcements about recent investments, they may not be active in the field. Have a look at, make sure there is a match of size, stage, and geography. So don't go to Apex partners and ask for $500,000 for a project. Understand what sized investments they make and understand what sector and geography they operate in. And I think that this is the key thing: relevant portfolio. So by relevant, there's two aspects to that. Firstly, kind of stuff which is in related businesses to yours, so that they're going to have an understanding of the business, so that their network is going to be valuable to yours, so that some of the companies they've already invested in may be interesting to you, but not a company without kind of directly competitive existing investments. And really, it's up to you to evaluate what constitutes a directly competitive investment to what you're in. And a good track record. The reason I say track record here is that in the VC world, there is a very, very strong virtuous circle of venture capitalists who have successful exits, have great relationships with founders. Therefore, they attract the best business plans the next time round, and so on. So, unlike in investments in public quoted equities, where they're always kind of sold with the caveat that past performance doesn't guarantee future performance. In VC, there is a strong correlation, and working with a VC who's got a good financial track record, as well as a good track record for adding value to entrepreneurs they work with, is important.
Can I just ask a question? How much, when you say that the VC adds value to the entrepreneur, we're talking about more than here's a pile of money, go and spend it. We could expect the right VC to come into the company and go, okay, look, you've got a great product in the market, but perhaps what we could do is target it at this market or get these people involved. We could expect it kind of hands-on.
So definitely, it's definitely hands-on. The comment I would make in respect of what you just said was that, we do have ideas, and and we will contribute ideas to a business. But it's rare that ideas are a scarce commodity. Usually, what's the scarce commodity is the executional ability around those ideas. So I think yes. Of course, when we get around the table, we do talk about different ideas that people have in the business. But really, particularly in kind of product development type businesses, we don't try and tell you to change the colour from red to green or to add these features. We expect you to understand very, very clearly, what the customer or consumer of the product wants, and have a very clear vision about how to take that forwards. That's an area which we'll discuss, but we won't try and that's really not where we add our value. We add the value really more around recruiting, getting the right people on board, and we just invested in the company, and I'm interviewing hundreds of people. I have interviewed about 30 or 40 people for a UK-based role for a company that's based out of Europe. So recruiting is a big part of it, and partnerships. Absolutely, and something like a Love Film, which we invested in. They went to pitch to Tesco to run the Tesco. The Tesco DVD rental service, and that was a pitch that Index people kind of went to and helped them prepare, and were intricately involved in a lot of the early, particularly in the formative stages of that company's development. And the way to find out if they will is to talk to other entrepreneurs who they've invested in the past. Not necessarily, if you do get to speak to entrepreneurs before you meet them and get some sense to it, but definitely before you actually take money from a VC, to make sure you've had some engagement with other firms that invested.
Yeah, I feel quite passionately about that, because when we raised the money for Move Fruit, we took 700,000, and then we took 5 million, and then we took another 3, and then we had the shall we float, shall we get acquired, shall we take another round from Apex? And I think we made some big mistakes there. So we took a accelerator fund over an angel, a very well-known angel, and actually I think we would have done better with that.
Ben's not really telling you the whole truth, which is that very often you can have a bad experience with VC. And in the case of Index, I don't think it happens very often, if at all. But when you get a VC, they almost always have a director on the board. If you get 3 or 4 VCs, you're not going to have 3 or 4 different VC investors having a representative on your board. And Boo.com is the best case in point, where there were so many investors on the board that the whole thing wasn't the only reason the Boo collapsed. It was a particularly disastrous legalist company because of the investors, I believe. And that is unusual when you get a lot of different investors. Even if you only got 1 or 2 VCs on your board, it's really, really important to make sure that the individual director is somebody you get on with, because they do have quite a lot of influence, whatever you say then, and it can actually be detrimental to that relationship with that person, and they have a lot of power with the investor in a sense. So if you have a conflict between you and the individual on your board, 2 individuals, that can be disastrous for the company. So it's really, really important when you're taking VCs to select a VC where you like the partners on your board and you like venture capital as well.
I just said a few more points here. So, in reality, out of the blue emails to investors, they do get looked at. But we fairly rarely do investments, where we haven't had some level of engagement with people before. So, what I'd encourage you is try to build some context around the discussion that you create with a VC. So events like this are good things to go to. Reading blogs, contributing to blogs, and watching what's happening in the blog sphere is now a good thing to do. Watching what press coverage is coming out about particular firms, about particular VCs, and trying to kind of engage with them using that as a hook does kind of give, as I say, give some context to the discussion, which is much better than an email coming out of the blue. As I say, VCs spend their time focusing on businesses which have momentum. That traction thing is really, when I spend my time kind of thinking where to invest, I'm looking for ideas and projects that have traction. So I think if you're really sitting there saying, I can't do anything with this business until I've raised the VC money, that's not a strong message. What the VC really wants to feel that they're going to add fuel to the car. They're the fuel. They're typically not the spark for a business. So really think, what can I do with no money that will really gain someone's attraction and prove that I can achieve stuff. The best indication we have of how well someone will do with money is how well they can do, how much they can achieve without money. I'm going to skip that. Well, so just roughly, so pre-meeting, I think a PowerPoint is a better thing than an A4 business plan. That's just my preference. And something in the kind of 20-page range is probably fine. Unless you're in a really, you've got very, very, very sensitive IP, I wouldn't try and press for an NDA with an investor. We typically don't sign them. What will happen is you'll have a series of meetings. If those go well, you'll have a final meeting usually with the VC partnership, and they will give you a term sheet after that. And depending on the complexities of the transaction, if a company's already been created, or if a new corporate structure needs to be created to allow the venture to move forwards, the legal process can take a month to a couple of months. Obviously, if you're raising angel financing or a small amount, these numbers tend to be slightly less.
Can I just ask you, interesting you say not to ask for an NDA, but also you're saying look for companies that have got businesses synergy. So, is that a bit of a conflict? Would you say that you can't get an NDA, or they just wouldn't sign an NDA?
So, as I say, I think at the end of the day, you've got to be the judge. I think the key thing is, though, quite often, we get emails saying, hello, I'm doing a business in this area. If you sign the NDA, and I'll send you the plan, and just you have to be realistic that you're competing with an awful lot of other ideas that are trying to raise money, and the more kind of hurdles you put in the way of that engagement, the tougher it is for you and the VC to progress it. So So yeah, I mean, absolutely. If IP is very, very central to your business, you've either got to be comfortable that you definitely trust the individual you're working with before, and that's what I said before about having some context of the discussion to build up that trust, so you can discuss it without an NDA, or if as I say, very occasionally we have signed NDAs where there's been some specific IP that needs to be protected for certain reasons.
Can I add to that? VCs won't invest in a direct competitor of something they've already invested in. So you should look at what else what's in their portfolio. If there's a direct competitor in there, don't bother to approach them. But if there isn't a direct competitor in there, you're actually looking like you're naive if you ask for an NDA. So I'd agree with Ben, just don't even bother to ask.
Yeah.
Quick question. Can you discuss this process with a series of
I think if you can think about that, the circles I had out before about, which of the universe of VCs who are most relevant in terms of size, stage, geography, and compatible but competitive, but not competitive investments. And I think it is worth, narrowing it down to a subset who you'd really like to raise money from, rather than kind of doing a mass mail to anyone of any description who may be able to fund you. So yeah, I would certainly kind of work with as few as you can, and I think VC, we don't respond to competitive tension when we sense that there's a lot of other VCs going for stuff. What really makes us want to get into something is if we see something that we make.
Sorry, I have to say something. Bite my tongue.
So I think. Yeah, and I mean, obviously, a lot of investments that we end up making, there is a competitive scenario, but I think if you're actively trying to engineer a competitive scenario and kind of give the nudge, wink, wink, this VC's got just about to offer us a term sheet, you're going to have to be quick, Sonny. That tends to be seen through, because all the VCs know each other, and they do kind of have a feeling for who's looking at what, so you can't.
It's more a question of conceptualising that how to be done.
Yeah, no, there are lots of good VCs in London, and some with, as I say, strengths in different areas, whether it's different sectors or different stages, and so yeah, work out who the 3 or 4 who are most relevant to you, and I approach that kind of quantum rather than approach 10 to 15.
I've known people do both, but the disadvantage with approaching lots of investors is there's a huge amount of your time which detracts you from spending time on the business. And if 10 people have said no, then you're probably going to still get no's from the next 20. So it's probably not worth your time going to lots of other people. But I know some entrepreneurs have been successful by talking to 30, 40 investors and eventually getting money. So
I mean, my perspective is valuation is entirely driven by having competition between VCs. I mean, when I started Fig Leaves, we were very, very particular about who we pitched to over 7 years. We got extremely promiscuous because reality is you can come up with your shortlist and want to talk to the blue chip people, but ultimately, if you need to raise money, ultimately you'll talk to anyone who's interested in investing. And when it comes, clearly one needs to be sophisticated in the way that one plays a VC, in the same way that they're sophisticated in the terms that they look for. But being sophisticated is, the VC needs to understand that it's a competitive market, and you're sensitive about valuation. And if one does that in a slick way, there is unquestionably a sort of a herd mentality where when the VCs I've been dealing with have sensed they might be losing a deal, they start sharpening their pencil.
I think there's a very practical part to that as well, which is these negotiations can take a while. You'll be lucky sometimes they'll close really quickly in 8 weeks or 12 weeks, but it has been known for them to drag on for months. And if you're only talking to 1 or 2 and then they both say no, then you've got to start the whole process again. So I think there's that to consider too.
I think the other thing might then be the team you've got. I mean, your case with Fig Leaves, you were probably still operating the business, running CEO, and Daniel was doing fundraising largely. And I've seen that work well, where you have one person whose whole job is fundraising in the top of the management team. If the CEO is also fundraising, it cops up the business.
This is important, but what's key is that there's a balance between investors or a fair balance between investors and entrepreneur. If you've got investors who have too little ownership, then then they're not inclined to work hard for your company, and vice versa for founders. And really, if you purely think about maximizing your own financial kind of well-being from a venture, that's really a function of what the value is of the business when you exit it, and what the probability of your getting to that exit, and what your share of the business at that exit will be. And there's a lot of things which influence the value at exit, as you know, the size and profitability of the business when you exit it, how fast it's growing, how strategically attractive is that to potential buyers, or how it's viewed in IPO markets. The probability of you getting there is really, how few errors you make along the way, how quickly you can hire people, how leveraged you can be through partnerships and so on, and how effectively you can do product development. And really, only it's in this share of the business of exits. So kind of 1 out of 13 factors is really just the valuation that you get for your initial round of financing, because you're probably going to have to raise more financing further on. So getting a bad investor who's happy to pay up a good valuation at the first round, may make it harder for you to raise money down the road. So I think, it's always a balance, and as I say, I would love you to work exclusively with one VC. I understand that you won't, but all I would say is, don't maximize, don't look solely at valuation. It's more a case of find the right partner at a fair price rather than any partner at the best price. And really, how do you find the right partner? It's the relationship with the key individual, as Simon's mentioned. References, do speak to other founders. Do they have a good portfolio? Is this a community of companies that you would like to be part of? Because there are a lot of kind of portfolio events and a lot of inter-company communication in the portfolio. And obviously valuation, as I mentioned, is important. I think that's all I had in this.